Hello everybody, it's Yashar here, back again with another video. And in this video, I'm going to analyze a Canadian REIT or real estate investment trust, NorthWest Healthcare REIT, which is surprisingly popular in Canadian investment communities, but I think this is a terrible investment at the moment. In the past, I analyzed their stock in another REIT analysis video. In that video, I mentioned that this stock is overvalued by more than 40% and it only passed 2 out of 6 REIT quality indicators. Let's just quickly recap a clip from that video right now. This indicator was payout ratio, and for NorthWest, it is close to 95.7%, which is absolutely not good. It means they almost pay all of their rent, all of their funds from operation income to unit holders as distribution and don't have much cash available to reinvest in themselves and grow in the future. Finally, let's quickly look at my personal discounted future FFO model. According to my model, if we expect 10% return year over year in the next 10 years, the fair value of NorthWest stock is around $6, which means compared to current share price of almost $10.8, the NorthWest shares are traded at 44% premium. As you can see here, NorthWest passed only 2 out of 6 REIT indicators that I defined before, and it is significantly overvalued according to the discounted future FFO model. I think they messed up huge in their recent investments with shareholders' money, and now they have to either cut their dividend, sell some of their assets, or dilute you as shareholder, which basically all means your invested money will lose its value. Yesterday, I read this comment in one of the Canadian investment subreddits, and it seems investors are really bullish about this REIT at the moment, and they are buying the dip without looking at the fundamentals of this stock or understand the risks here. A lot of investors love this REIT or similar REITs because of their super high dividend yield at the moment, which on paper can be great for passive income investors. I looked closely at the financial of these REITs and read their recent earnings report, and I told myself I have to post this video today to warn you or at least share my opinions on this super risky investment. NorthWest Healthcare REIT owns a portfolio of international healthcare real estate infrastructure with almost 190 income-producing medical office buildings, clinics, and hospitals located in Canada, Brazil, Europe, Australia, and New Zealand. Their shares are traded on TSX for almost $9 Canadian at the time of recording this video, and they pay a monthly distribution with a starting yield of 8%. Unfortunately, the good news about NorthWest ends here. The first red flag is in their latest earnings report. Their adjusted funds from operation, which is the most important metric for a REIT, is down significantly from 21 cents per share to 15 cents per share, which is a whopping 28% decrease in FFO of the company in just one quarter, apparently due to a bad investment decision. Their adjusted funds from operation is 15 cents per share, and they pay 20 cents per share as distribution or dividend. So their adjusted FFO payout ratio is now at 132%, which is absolutely crazy. The company does not earn enough money from their operations to even pay the dividend or distribution to unit holders. It means the company don't have any cash available to reinvest in themselves or pay down their debt, and they have to cut the dividend or sell some of their assets or dilute even harder to be able to raise capital. This is the management explanation for the reasons behind this sudden drop in adjusted funds from operation per share. FFO is being adjusted for net losses incurred with respect to an investment in an unlisted securities and certain G&A, which is general and administrative expenses, that in each case management views as not reflective of recurring earnings from core operations. Okay, my question is, what are these unlisted securities? The management did not even explain what is going on here, which is even worse than losing shareholders' money in my opinion. I mean, were they invested in something like FTX? Unlisted security can be anything. I don't know. They also raised so much capital via debt and share dilution in the past quarter. You can see a list of these debts here in this report. The next huge red flag, in my opinion, is insider selling activities. The CEO of the company is dumping shares left and right, especially in the last couple of weeks. This is very concerning. The management team received their options for almost free, diluting you this way like there is no tomorrow, and then dumping shares on open market aggressively, which should always be a red flag for investors. The next series of red flags is about the fundamentals of this business. An important quality indicator for a REIT is share dilution rate. NorthWest consistently dilute unit holders to raise capital and to pay their management team, but what is more important is the ratio between cash flow generation growth rate or adjusted funds from operation growth rate and share dilution rate, which can be found via AFFO per share growth ratio. And it is obvious that NorthWest did not really grow its cash flow or funds from operation in the last few years, which means all their share dilutions were actually useless for shareholders of the company. Another indicator is their debt to asset ratio, which is 46.2% for NorthWest at this point, with an average interest rate of 3.77%, which is, I would say, is not good. They need to renew some of these loans in the next year, and with high interest rates, they need to pay even more interest on these loans, which will put so much pressure on their balance sheet and adjusted funds from operations in the future. Finally, NorthWest has an equal net asset value and market cap right now, but the real value of their investments can be much lower than what they are reporting here because of the recent downturn in the real estate market and rising interest rates. So if they sell all of their assets tomorrow and pay down their huge liabilities, there is potentially not enough cash to even cover the investors' money. For all the reasons that I mentioned here, I would avoid investing in NorthWest Healthcare REIT. Is it possible that they find a way to cover the dividend and rebound their FFO in the next few quarters or the next few years? Of course, yes. There is always that possibility, but in investing, you always need to look at the risk and reward profile. In my opinion, investing in NorthWest is a high risk, low reward investment. You take on a huge risk of dividend cut, share price destruction, and a slowdown in the earnings of the company in the worst case for a modest return close to the average of the market in the best possible outcome. I wish you all the best in your investment journey, and I hope things works out for the investors in NorthWest in the long term, but I personally would avoid this. There you are, guys. I hope you enjoyed the video, and if you enjoyed this video, don't forget to subscribe to see similar videos. Thank you for watching, and I see you guys in the next video. Farewell.